of Management Studies IGNOU presents an audiobook on the course Mmpc 017 Advanced Strategic Management for MBA program. Presenting Block 2 Corporate Level Growth Strategy. Unit 4 Integration and Diversification Growth Strategies Part 2.
Merger and acquisition strategy. There are a number of reasons that mergers and acquisitions take place. These issues generally relate to business concerns such as competition, efficiency, marketing, product, resources, and tax issues. They can also occur because of some very personal reasons such as retirement and family concerns. Some people are of the opinion that mergers and acquisitions also occur because of corporate greed to acquire everything. Various reasons for M&A include reduce competition. One major reason for companies to combine is to eliminate competition. Acquiring a competitor is an excellent way to improve a firm's position in the marketplace. It reduces competition and allows the acquiring firm to use the target firm's resources and expertise. However, combining for this purpose is as such not legal, and under the Antitrust Acts, it is considered a predatory practice. Therefore, whenever a merger is proposed, firms make an effort to explain that the merger is not anti-competitive and is being done solely to better serve the consumer. Even if the merger is not for the stated purpose of eliminating competition, regulatory agencies may conclude that a merger is anti-competitive. However, there are a number of acceptable reasons for combining firms. Cost efficiency. Due to technology and market conditions, firms may benefit from economies of scale. The general assumption is that larger firms are more cost effective than are smaller firms. It is, however, not always cost effective to grow. In spite of the stated reason that merging will improve cost efficiency, larger companies are not necessarily more efficient than smaller companies. Further, some large firms exhibit diseconomies of scale, which means that the average cost per unit increases as total assets grow too large. Some industry analysts even suggest that the top management goes in for mergers to increase its own prestige. Certainly, managing a big company is more prestigious than managing a small company. Avoid being a takeover target. This is another reason that companies merge. If a firm has a large quantity of liquid assets, it becomes an attractive takeover target because the acquiring firm can use the liquid assets to expand the business, pay off shareholders, etc. If the targeted firm invests existing funds in a takeover, it has the effect of discouraging other firms from targeting it because it is now larger in size and will therefore require a large tender offer. Thus, the company has found a use for its excess liquid assets and made itself more difficult to acquire. Often firms will state that acquiring a company is the best investment the company can find for its excess cash. This is a reason given for many conglomerate mergers. Improve earnings and reduce sales variability. Improving earnings and sales stability can reduce corporate risk. If a firm has earnings or sales instability, merging with another company may reduce or eliminate this provided the latter company is more stable. If companies are approximately the same size and have approximately the same revenues, then by merging they can eliminate the seasonal instability. This is, however, not a very efficient way of eliminating instability in strict economic terms. Market and product line issues. Often mergers occur simply because one firm is in a market that the other company wants to enter. All of the target firm's experience and resources are readily available for immediate use. This is a very common reason for acquisitions. Whatever may be the explanation offered for acquisition, the dominant reason for a merger is always quick market entry or expansion. Product line issues also exert powerful influence in merger decisions. A firm may wish to expand, balance, fill out, or diversify its product lines. For example, acquisition of Modern Foods by Hindustan Lever Limited is primarily related product line. Acquire resources. Firms wish to purchase the resources of other firms or to combine the resources of the two firms. These may be tangible resources such as plant and equipment, or they may be intangible resources such as trade secrets, patents, copyrights, leases, management, and technical skills of target companies' employees, etc. This only proves that the reason for mergers and acquisitions are quite similar to the reasons for buying an asset or to purchase an asset for its utility. Synergy. Synergy, popularly stated as 2 plus 2 equals 5, is similar to the concept of economies of scope. Economies of scope would occur if two companies combine and the combined company was more cost efficient at both activities because each requires the same resources and competencies. Although synergy is often cited as the reason for conglomerate mergers, cost efficiencies due to synergy are difficult to document. Tax savings. Although tax savings is not a primary motive for a combination, it can certainly sweeten the deal. When a purchase of either the assets or common stock of a company takes place, the tender offer less the stock's purchase price represents a gain to the target company's shareholders. Consequently, the target firm's shareholders will usually gain tax benefits. However, the acquiring company may reap tax savings depending on the market value of the target company's assets when compared to the purchase price. Also, depending on the method of corporate combination, further tax savings may accrue to the owners of the target company. Cashing out. For a family-owned business, when the owners wish to retire or otherwise leave the business and the next generation is uninterested in the business, the owners may decide to sell to another firm. For purposes of retirement or cashing out, if the deal is structured correctly, there can be significant tax savings. To summarize, firms take the M&A route to seize the opportunities for growth, accelerate the growth of the firm, access capital and brands, gain complementary strengths, acquire new customers, expand into new product market domains, widen their portfolios, and become a one-stop shop or end-to-end solution provider of products and services. Reasons for failure of merger and acquisition. The record of M&A world over has not been impressive. Advocates of M&As argue that they boost revenues to justify the price premium. The notion of synergy 1 plus 1 is equals to 3 sounds great, but the assumptions behind this notion are too simplistic. In real life, things are not that simple and rosy. Past trends show that roughly 2/3 of all big mergers have not produced the desired results. Rationale behind mergers can be flawed and efficiency from economies of scale may prove elusive. Moreover, the problems associated with trying to make merged entities work cannot be overcome easily. Reasons supporting the use of diversification have been explained in the previous section. The potential pitfalls of this strategy are explained in this section. The conclusion that one may draw from this discussion will be that successful diversification would involve a well-thought strategy in selecting a target, avoiding overpaying, creating value in the integration process. The potential pitfalls that a firm is likely to encounter during diversification include integration difficulties. Integrating two companies following mergers and acquisitions can be quite difficult. Issues such as mending two disparate corporate cultures, linking different financial and control systems, building effective financial and control systems, building effective working relationships, etc., will come to the fore and they have to be contend with. Faulty assumptions. A booming stock market encourages mergers, which can spell danger. Deals done with highly rated stock as currency appear easy and cheap, but underlying assumptions behind such deals is seriously flawed. Many top managers try to imitate others in attempting mergers, which can be disastrous for the company. Mergers are quite often more to do with personal glory than business growth. The executive ego plays a major role in M&A decisions, which is fueled further by bankers, lawyers, and other advisors who stand to gain from the fat fees they collect from their clients engaged in mergers. Most CEOs and top executives also get a big bonus for merger deals, no matter what happens to the share price later. Mergers are also driven by fear psychosis, fear of globalization, rapid technological developments, or a quickly changing economic scenario that increases uncertainty can all create a strong stimulus for defensive mergers. Sometimes the management feels that they have no choice but to acquire a raider before being acquired. The idea is that only big players will survive in a competitive world. Failure to carry out effective due diligence. The failure to complete due diligence often results in the acquiring firm paying excessive premiums. Due diligence involves a thorough review by the acquirer of a target company's internal books and operations. Transactions are often made contingent upon the resolution of the due diligence process. An effective due diligence process examines a large number of items in areas as diverse as those of financing the intended transaction, differences in cultures between the two firms, tax concessions of the transaction, etc. Inordinate increase in debt. To finance acquisitions, some companies significantly raise their levels of debt. This is likely to increase the likelihood of bankruptcy, leading to downgrading of firms' credit rating. Debt also precludes investment in areas that contribute to a firm's success, such as R&D, human resources development, and marketing. Too much diversification. The merger route can lead to strategic competitiveness and above average returns. On the flip side, firms may lose their competitive edge due to over diversification. The threshold level at which this happens varies across companies, the reason being that different companies have different capabilities and resources that are required to make the mergers work. Crossing these threshold limits can result in overstretching these capabilities and resources, leading to deteriorating performance. Evidence also suggests that a large size creates efficiency in various organizational functions when the firm is not too large. In other words, at some level, the costs required to manage the larger firm exceed the benefit of efficiency created by economies of scale. Problems in making M&A work. Mergers can distract them from their core business, spelling doom for the company. The chances for success are further hampered if the corporate cultures of the companies are very different. When a company is acquired, the decision is typically based on product or market synergies. But cultural differences are often ignored. It is a mistake to assume that these issues are easily overcome. A McKinsey study on mergers concludes that companies often focus too narrowly on cutting costs following mergers without paying attention to revenues and profits. The exclusive cost-cutting focus can divert attention from the day-to-day business and poor customer service. This is the main reason for the failure of mergers to create value for shareholders. However, not all mergers fail. Size and global reach can be advantageous, and tough managers can often squeeze greater efficiency out of poorly run acquired companies. The success of mergers, however, depends on how realistic the managers are and how well they can integrate the two companies without losing sight of their existing businesses. Though the acquisition strategies do not consistently produce the desired results, some studies suggest uncertain decisions and actions that firms may follow which can increase the probability of success. The attributes leading to successful acquisitions suggested by various studies are that the acquired firm has assets or resources that are complementary to the acquiring firm's core business. Acquisition is friendly. Acquiring firm selects target firms and conducts negotiation carefully and methodically. Acquiring firm has adequate cash and favorable debt position. Merged firms maintain low to moderate debt position. Acquiring firm has experience with change and is flexible and adaptable. Acquiring firm maintains sustained and consistent emphasis on R&D and innovation. Steps in merger and acquisition deals. A firm that intends to take over another one must determine whether the purchase will be beneficial to the firm. To do so, it must evaluate the real worth of being acquired. Logically speaking, both sides of an M&A deal will have different ideas about the worth of a target company. The seller will tend to value the company as high as possible, while the buyer will try to get the lowest price possible. There are, however, many ways to assess the value of companies. The most common method is to look at comparable companies in an industry, but a variety of other methods and tools are used to value a target company. A few of them are listed below. 1. Comparative ratios. The following are two examples of the many comparative measures on which acquirers may base their offers. P/E, price to earnings ratio. With the use of this ratio, an acquirer makes an offer as a multiple of the earnings the target company is producing. Looking at the P/E for all the stocks within the same industry group will give the acquirer good guidance for what the target's P/E multiple should be. P/S, price to sale ratio. With this ratio, the acquiring company makes an offer as a multiple of the revenues, again while being aware of the PSN ratio of other companies in the industry. 2. Replacement cost. In a few cases, acquisitions are based on the cost of replacing the target company. The value of a company is simply assessed based on the sum of all its equipment and staffing costs without considering the intangible aspects such as goodwill, management skills, etc. The acquiring company can literally order the target to sell at that price, or it will create a competitor for the same cost. This method of establishing a price certainly would not make much sense in a service industry where the key assets, people and ideas are hard to value and develop. 3. Discounted cash flow. An important valuation tool in M&A, the discounted cash flow analysis determines a company's current value according to its estimated future cash flows. Future cash flows are discounted to a present value using the company's weighted average cost of capital. 4. Synergy. Quite often, acquiring companies pay a substantial premium on the stock value of the companies they acquire. The justification for this is the synergy factor. A merger benefits shareholders when a company's post-merger share price increases by the value of potential synergy. For buyers, the premium represents part of the post-merger synergy they expect can be achieved. The following equation solves for the minimum required synergy and offers a good way to think about synergy and how to determine if a deal makes sense. In other words, the success of a merger is measured by whether the value of the buyer is enhanced by the action. The equation: pre-merger value of both firms plus synergies by post-merger numbers of shares is equals to pre-merger stock price. Here the pre-merger stock price refers to the price of the acquiring firm. Increase in the value of the acquiring firm is a test of success of the merger. However, the practical aspects of mergers often prevent the anticipated benefits from being fully realized, and the expected synergy quite often falls short of expectations. Some more criteria to consider for valuation include a reasonable purchase price, a small premium of say 10% above the market price is reasonable. Cash transactions. Companies that pay in cash tend to be more careful when calculating bids, and valuations come closer to target. When stock is used for acquisition, discipline can be a casualty. Sensible appetite. An acquirer should target a company that is smaller and in a business that the acquirer knows intimately. Synergy is hard to create from disparate and unrelated businesses. And sadly, companies have a bad habit of biting off more than they can chew in mergers. The basic steps in mergers and acquisitions are: 1. Initial offer by the intending buyer. When a company decides to go for a merger or an acquisition, it starts with a tender offer. Working with financial advisors and investment bankers, the acquiring company will arrive at an overall price that it's willing to pay of its target in cash, shares, or both. The tender offer is then frequently advertised in the business press, stating the offer price and the deadline by which the shareholders in the target company must accept or reject it. 2. Response from target company. Once the tender offer has been made, the target company can do one of the several things listed below. Accept the terms of the offer. If the target firm's management and shareholders are happy with the terms of the transaction, they can go ahead with the deal. Attempt to negotiate. The tender offer price may not be high enough for the target company's shareholders to accept, or the specific terms of the deal may not be attractive. If target firm is not satisfied with the terms laid out in the tender offer, the target's management may try to work out more agreeable terms. Naturally, highly sought after target companies that are the object of several bidders will have greater latitude for negotiation. Therefore, managers have more negotiating power if they can show that they are crucial to the merger's future success. Execute a poison pill or some other hostile takeover defense. A target company can trigger a poison pill scheme when a hostile suitor acquires a predetermined percentage of company stock. To execute its defense, the target company grants all shareholders except the acquirer options to buy additional stock at a hefty discount. This dilutes the acquirer's share and stops its control of the company. It can also call in government regulators to initiate an antitrust suit. Find a white knight. As an alternative, the target company's management may seek out a friendly potential acquirer or white knight. If a white knight is found, it will offer an equal or higher price for the shares than the hostile bidder. 3. Closing the deal. Finally, once the target company agrees to the tender offer and regulatory requirements are met, the merger deal will be executed by means of some transaction. In a merger in which one company buys another, the acquirer will pay for the target company's shares with cash, stock, or both. A cash for stock transaction is fairly straightforward. Target company shareholders receive a cash payment for each share purchased. This transaction is treated as a taxable sale of the shares of the target company. If the transaction is made with stock instead of cash, then it's not taxable. There is simply an exchange of share certificates. The desire to steer clear of the taxman explains why so many M&A deals are carried out as cash for stock transactions. When a company is purchased with stock, new shares from the acquirer's stock are issued directly to the target company's shareholders, or the new shares are sent to a broker who manages them for target company shareholders. Only when the shareholders of the target company sell their new shares are they taxed. When the deal is closed, investors usually receive a new stock in their portfolio. The acquiring company's expanded stock. Sometimes investors will get new stock identifying a new corporate entity that is created by the M&A deal. Mergers and acquisitions, the Indian scenario. M&A activity had a slow takeoff in India. Traditionally, Indian promoters have been very reluctant to sell out their businesses since it was synonymous with failure and was never viewed as a sensible move. This scenario changed dramatically in the 90s with the Tata selling Tomco and Lakme. Suddenly, selling out had become a sensible option. The second major reason for the slow takeoff of M&A activity was due to the fact that even while the companies continued to decline, the banks and financial institutions, normally the biggest stakeholders in most Indian companies, are reluctant to change the managements. Fortunately, this situation has changed for the better. Worried about the spectre burgeoning NPAs, these institutions are now willing to force the promoters to sell out. The FIs and banks are flushed with funds and they are willing to assist big companies in acquiring new companies. Indian cement industry was trendsetter in M&A in India. The cement industry was ripe for consolidation in many ways. The industry comprised of 4 or 5 dominant players in addition to a number of small players having economically viable capacities but with very small market shares. Rapid expansion by the bigger players in a capital-intensive industry meant that these small players would naturally be marginalized. Moreover, the excess capacity due to rapid expansion of big players meant that the smaller players would lose money. This situation naturally spurred the merger activity in the cement industry. The past few years were record years for M&A globally, with mega deals dwarfing the previous records. M&A has also become a buzzword among Indian companies as well. HDFC Times Bank, Gujarat Ambuja TLF, and ICICI Bank Centurion Bank mergers were in the news for this reason. The merger wave in the country was catalyzed by economic liberalization in 1991. M&A activities on the rise and the Indian industry has witnessed a spate of mergers and acquisitions in the past few years. Mergers and acquisitions are here to stay. Mergers and acquisitions in India, just as in other parts of the world, are primarily aimed at expanding a company's business and profits. Acquisitions brings in more customers and business, which in turn brings in more money for the companies, thus helping in its overall expansion and growth. More and more companies are therefore moving towards acquisitions for a fast-paced growth. Consolidation has become a compelling necessity to counter the effects of increasing globalization of businesses, declining tariff barriers, price controls, and to please the ever-demanding and discerning customers. And these pressures are expected to intensify and relentlessly batter every business in the future. The M&A activities helping the companies restructure, gain market share or access to markets, rationalize costs and acquire brands to counter these threats. The shareholders of many companies are also supporting these moves, and sharp increase in share prices is an indication of the support. Since size and focus are factors that matter for surviving the onslaught of competition, mergers and acquisitions have emerged as key growth drivers of Indian business. Tax benefits were the sole reason to justify mergers in the past, but for many Indian promoters, that is no longer an incentive. Indian companies have taken to M&A for many reasons. Experts feel that Indian companies look at M&As due to the size factors, the niche factor, or for expanding their market reach. They are also of the opinion that acquisitions helps in the inorganic and quicker growth of the business of a company. Besides these factors, the pricing pressures and consolidation of global companies by building offshore capabilities have made M&A relevant for Indian enterprises. Many Indian companies have also followed the M&A route to grow in size by adding manpower and to facilitate overall expansion by moving into new market space. Another reason behind M&A has been to gain new customers. For instance, Moksha, an IT firm, saw a rise in the number of its customers due to acquisitions as it expanded considerably in the US market and leveraged on the existing customer base. Similarly, Mphasis added new customers in the Japanese and Chinese markets after the acquisition of Navian. The need for skill enhancement seems to be another major reason for companies to merge and make new acquisitions. The Polaris Orbitech merger helped in combining skill sets of both companies, which subsequently led to growth and expansion of the merged entity. Likewise, Wipro acquired GE Medical Systems Information Technology, India, to leverage its expertise in the health science domain. Summary. Diversification involves moving into new lines of business. Of the various routes to expansion, diversification is definitely the most complex and risky route. Diversification of a firm can take the form of concentric and conglomerate diversification. A firm is said to pursue concentric diversification strategy when it enters into new product or service areas belonging to different industry category, but the new product or service is similar to the existing one in many respects. The two major routes to diversification are mergers and acquisitions and strategic partnering. 1 plus 1 makes 3. This equation is the special alchemy of a merger or acquisition. Although they are used synonymously, there is a slight distinction between the terms merger and acquisition. The term acquisition is generally used when a larger firm absorbs a smaller firm, and merger is used when the combination is portrayed to be between equals. Firms take the M&A route mainly to seize the opportunities for growth, accelerate the growth of the firm, access capital and brands, gain complementary strengths, acquire new customers, expand into new product market domains, widen their portfolios, and become a one-stop shop or end-to-end solution provider of products and services. The three basic steps in the merger process are offer by the acquiring firm, response by the target firm, and closing the deal. M&A activity had a slow takeoff in India. However, M&A has become a buzzword among Indian companies after the economic liberalization in 1991. M&A activity is on the rise, and the Indian industry has witnessed a spate of mergers and acquisitions in the past few years.
You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code Mmpc 016 International Business Management. Course Coordinator Professor G. Subayama. Voiceover by Chitra. Edited by Ashok Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.